Good evening, everyone. Welcome to the StashAway Market Outlook webinar. And thanks for taking the time to hear us out. It's always good to once in a while catch up, reflect and review what's happened in the markets, recall some key investment philosophies and review our plans before we move forward. So this is always a good time to sort of have this catch up, and it's personally for me, it as I speak in this seminar, it does make things clearer even for myself. So a big welcome to all of you, and for those of you who don't know me or see me for the first time. My name is Freddy Lim, and I'm a co-founder and chief investment officer for StashAway. And I have been the architect of the investment framework called ERAA, which stands for Economic Regime as Allocation, which is the primary engine and framework for how we manage portfolios at StashAway. So without further ado, let's just start with the elephant in the room. I would say the elephant in the room would be, let's look at the list of assets that we invest on the platform, and let's look at those that has the most negative return on a year-to-date basis this year. Let's talk about, and in particular, I highlighted on the left side of the table, row 16, the China internet stocks sector. I also highlighted the very long-dated government bond markets in the US as being the most depressed sectors or asset classes that we monitor and that we invest. On the right side of the table are the allocations, like actually how much we invest them on your behalf by your StashAway risk index. And for newcomers to the platform, StashAway risk index is a extreme risk measure that our algorithms are calculated based on historical stress scenarios in financial markets, and it's also how you are profiled and how we recommend a risk point to you when you first sign up to the platform. So depending on which portfolios you have, you will have different allocations across different asset classes. So it is a different experience for everyone. What's good about this table is I felt that it also gives you a more holistic picture of the investable universe, because at any moment in time, the algorithm is investing in between 7 to 10 of these 35 asset classes for our global portfolios. For other kinds of portfolios on the platform, there's also a bigger and a different list. So users don't actually tend to see the whole list that we choose from. And this is growing over time. But it's good to just give you a holistic picture today. And as the graph is shown, this is all in US dollar terms. Kwsp, which is China Crane Shares Innovations stock ETF, is down 8.3 percentage point for the year. And a lot of it has to do with the ramp up in antitrust regulations and some fines on the likes of Alibaba in China. And clearly, there's a lot of concerns. But in general, one has to remember the key medium to long-term trend in China, which is the government itself is restructuring its society, its economy, with a very heavy tech focus. The trade war between US and China is no longer just US and China. It has actually broadened out to become China versus the West. And that means China is finding it unreliable or less secured to rely on other countries for, importing chips and hardwares or semiconductor-related components. As a result, semiconductors itself, the entire ecosystem, is going to one day morph into a two superpower ecosystems, where it's going to be one that suits the US and another part of the ecosystem that caters to China. So it is very important to think about the implications, because that means China is going to heavily invest, not just semiconductors, it's just an example, but all things related to consumer tech, electric vehicles, clean energies, and a lot more of these are going to be a big priorities for the nation. And so it's important to not let the short-term headwinds derail oneself from this big, medium to long-term game-changing trend in the society. So that's sort of the summary here for China innovations. Of course, in the near term, we actually can see that the China authorities is actually quite active in really creating a framework around big tech firms in China. They want to make sure there's now a proper formal framework for protecting consumer privacy, consumer data. And then the antitrust component is to ensure that the kingmakers in the ecosystem, which tends to be Alibaba on one side, Tencent on the other side, they want to try to level the playing field where smaller startups and smaller tech companies are no longer beholden to the big influences of the kingmakers in the system. So all those are actually very healthy restructuring of the landscape in China in the medium to long term. In the near term, it's causing some very, very short-term sort of blips and eyebrows for sure. However, this is a huge market with a very, very huge long-term potential. So this is sort of the dilemma that face investors. And the best way to sort of, the best answer to staying invested in this China innovation sector is to sort of have a very, very balanced, have a very diversified, have a very global portfolio that sort of gives you that protection through protective assets elsewhere in your portfolio. A concentrated investment here would naturally be very volatile. Now, putting the numbers in perspective, again, like I said, year to date, down 8.3%, but if you're slightly more patient and just look at the things starting to change, and again, actually the sector is still net up nearly 40% over a one-year basis. This one-year basis is as of last night versus a year ago. And so it goes to show that the numbers gets even more impressive as you look longer term. So it goes to sort of show that, you know, sticking to your investment plan, knowing your horizon, knowing why you invest, if you're investing for retirement, it's very long dated. Knowing that is very key to realizing those potential. The last thing we want to do is to overreact to a little blip here and there in the markets and all the noises trumpeted by the media. That easily, if that takes you out of the game, the compounding, the power of compounding is not going to happen. So it's very clearly demonstrated here in row 16. I circle it on the table. Row 20 to 21 is the other thing that a lot of people talk about. So this table really actually, by looking at the changes in this table, you already know where the media is going to focus their attention. And for a while, there's been a lot of fear and talk about inflation, and that fear supposedly was driving the downturn in the government bond markets, especially the long-dated one. It is true, while it's true there is some rise in inflation in places like commodities, metals, food prices and all, but they're actually more related to COVID-19, the pandemic situation. It's a supply chain disruption sort of causes, as rather than being driven by money printing, rather than driven. So all this sell-off in the bond market is really more driven by supply, bond market supply, than inflation. The bond market supply is a function of the new Biden administration coming in, being very big and bold with structural policies. As you know, some of you, the Biden administration is actually proposing $6 to $7 trillion of infrastructure spending, clean energy reform, and including the COVID relief this year is going to tally to around 6 to 7 trillion. It's a proposal. The final number is likely to end up being a lot smaller, possibly between 3 to 7. So it could end up between 4.5 to 5. Who knows? The thing is that somebody has to pay for it in the future. And if taxes are not raised, who else is going to pay for it? So that sort of concern is very natural. And the bond market is sort of the engine that sort of try to absorb this information, trying to price this additional supply that's going to come in. The government will have to pay for it. Will have to issue new bonds, very long-term bonds, and this liability will stay around for a very long time. So rightfully, TLH, TLT, that these two ETFs here, they would react the most. And as you can see on a year-to-date basis, TLH is down 10.4%, TLT down 12.2%. On a one-year basis, they are down slightly even more, close to 14 to 15%. So clearly, it was a very big move for protective assets like the bond market. Now, if you look across the table where all the allocations are, StashAway actually did not have any amount invested in TLH or TLT. We do have through other ETFs such as IGOV, which is the international equivalent, meaning it doesn't just include the US, it has the countries globally around the world. And also this duration, the maturity of the bonds being owned by IGOV on row 22 is a lot smaller. So as you can see, as you go down the risk spectrum, the safer the portfolio, the more you are invested in IGOV. And the reason is IGOV is some of the most diversified government bond ETFs around, and with a shorter exposure to this long-term concerns about who is going to pay for all the stimulus that we have seen because of COVID-19. I just sort of want to highlight the elephant in the room. EMB, emerging markets as well. So you can see how it evolves, all the allocations, and the color code will tell you how heavy, how high, or how little your particular portfolio will be invested in that. Now for Kwsp China, which is China Innovations, obviously the highest risk portfolio on the platform will be the portfolio that takes on the highest volatility in any asset class as opposed to the others. So for the highest risk portfolio, SRI 36%, over here, if you see my mouse, we do have a good amount, 20% invested in China Innovations. That's because it's the highest risk portfolio by design. Now, however, the number goes down dramatically as you go to the other risk ratings. And actually, SRI 36 is the only one with such a high allocation. Most portfolios have a very standard allocation decided by the algorithms. And everything is based on correlation. Everything is based on the volatility of the asset class relative to the others. So as you choose a higher risk portfolio, higher risk assets will come in. You choose a lesser risk portfolio, you get more protective assets. So it's quite natural to see from the table how things are being allocated. Hopefully this will clear out for some of you and give you a holistic picture of how the platform works, why are you seeing certain assets, why are you not seeing certain things. So hopefully I provide a forest rather than a tree today. And at the bottom, the last two ETFs are quite interesting. As you know, StashAway were at the very beginning of the year, we were very focused on trying to, we actually launched automated metrics that captured data about the ESG scores of all the investments we made. And but not being explicitly labeled ESG funds, however, we do have very high ESG scores based on a combination of MSCI and Morningstar rating on the funds that we invest in, which is from ETF row number 1 to all the way to 33. So that was the beginning of the year. And shortly after, we done a lot more research to try to find if there's any explicit ESG funds that's very focused on ESG that provides differentiated returns, differentiated risk profile to the platform. So not to reinvent the view, but that this particular ESG ETFs would bring better risk-adjusted performance to the platform. and which culminated in one of our CIO insights that actually we formally introduced the iShares MSCI KLD 400 Social ETF, which is called DSI in the second last row. We formally welcome it to the investable universe. We to date have not invested in it, but the algorithms going forward, depending on the economic signals, valuation signals, may decide from time to time to change allocation in and out of these things. So it's part of the universe now. And the other one is actually ESG aware, the MSCI Emerging Market ESG Aware ETF that sort of broaden the exposure of ESG to whenever is the ideal to have them on the portfolio, the algorithm will go into it. At the moment, we are not invested in there yet, but I felt that since it's on the universe, let's show the whole forest. Happy to answer questions later in the Q&A section. So these are just to kickstart the conversations for later. Again, I've shown the year-to-date and the one-year dollar-based return for the ETFs. For those of you who's interested in how your portfolio is doing before fees, you can see at the bottom, we have a year-to-date and a one-year and the last one-year metric over here in the bottom table. So StashAway year-to-date, the return ranged from minus 1.6% for the lowest risk portfolio to plus 6.4% for SRI 30. So there's a range of the year-to-date return for 2021. And over the last 1 year, our returns has ranged from 5.4 percentage point for the lowest risk to 36.4% at the higher risk spectrum. And on average, most of your portfolios would see 7 to 10 ETFs being invested. And depending on which risk profile, if you're on the lowest risk profile, you will have less growth-oriented assets. So for SRI 6.5% on the rightmost column, you will see that you only have around 28.5 percentage point of your funds being exposed to growth and 71.5 percentage point of the funds exposed to protective assets. That completely flips around when you go to the highest risk profile where SRI 36% over here, if you look at my mouse, would have 72.7 percentage point of growth and 27.3 percentage point of protective. Now, this sort of split and allocation, they change, as you know, on our platform from time to time, depending on economic cycle and depending on the valuations of this asset class as well. If we're in good times, but if something is massively overvalued, it doesn't mean StashAway will continue to invest in those risky assets. We have to rebalance those risks and we'll look elsewhere for opportunities. So this growth versus protective thing is just a guide. It doesn't mean it's always true that it's going to be fixed. So in the very good times, you will see the growth portion for the higher risk portfolio being even larger. However, because there's still a lot of uncertainty in the world since last year, March, and you know that we have been in an all-weather strategy for a while. We are very concerned about risk such as inflation, such as the dilution of paper money because of all the money printing that we have seen done by governments around the world, by central banks around the world. So it's not just about growth. There's so many other risk factors that's in the world right now that the algorithm is trying to protect you from a suite of factors rather than just thinking about whether it's good times or bad times. So as a result, maybe you will feel that the growth component, if you've chosen the highest risk portfolio, it may have felt like, hey, I thought I should have 100% growth orientation for SRI 36%, but hey, I only have 73. And that's because there's other risk factors being at play as well. In very good times, when risk of other factors is very low, you will probably see 100% for sure. But it depends on the economic situation. It depends on valuation. So hopefully this gives you the forest. I linger on this slide a lot just to hopefully be able to give you a holistic treatment to how you feel about your portfolios. Now, the same table in Sing dollar terms for a lot of you who's in Singapore, and I know a lot of you also look at US dollar because you're in Malaysia, in Thailand, in Hong Kong, and Dubai. So we provided you with two different numbers. These numbers, the conclusions are essentially the same. The numbers will slightly change because of currency effect, but the conclusion, but it doesn't really change. So I wouldn't dwell on this table so much unless it comes out in the Q&A. Now now we have done a big overview, but let's just pin down some big economic themes that we are seeing from our investment models and algorithms and the data we have coming in. In particular, the media has been very focused on the orange line here, which is inflation. As you know, the US inflation actually gone up quite substantially in the last 3 months, having gone from around 2%, it went to 4.2, and then now it's 5% for the end of May, in a pretty rapid fashion, and that actually causes a lot of concern with a lot of investors. But at a global level, the numbers is lower. It's about 2.1 percentage point, according to the StashAway's proprietary index for global inflation. This index looks at all major economies in the world, and each country is weighted by their impact on their economic importance, their market share, to come up with this orange line. So at a global level, it's also rising as well, but it is coming off a low base. It's not considered anywhere near hyperinflation. Hyperinflation is at 2.1 currently. Hyperinflation, you will see sort of 12 percentage point, sort of a number for the global aggregate. So this is not alarming, but there is a clear indicator that supply chain disruptions is causing some bottlenecks in how producers respond to production, how they distribute their output. And that has actually caused a rise in food prices in particular, and prices in copper, nickel, all these base metals were also in the line of fire, and even other commodities. And however, I would like to caution against being overly reactive to it, because these are very transitory factors. They are not caused by central bank printing money or caused by some structural change in the economy. It's not caused by wages yet. It's really about supply chain disruptions. So hiking interest rate, if the central bank actually high interest rate, is going to make things worse because it's not going to stop. It's not going to change the problem with how producers supply us their output, right? It's just going to make things more expensive even further, because companies will now find it more difficult to finance themselves. Cost of borrowing is going to go up. It actually hurts consumers more. So a lot of naysayers in the market, but I take it with a grain of salt. The Federal Reserve is not stupid. They're very experienced, and they have repeatedly said what I just said, that inflation is not structural and these transient factors are at play. And these transient factors either goes away when companies adjust their supply chain in a few years, or if the COVID vaccines are able to drive a reopening of borders around the world, that pressure valve will just goes away. So it is likely to be transient, in my personal opinion. So I want to just make sure we put it in the right perspective. Naysayers, there are a lot of naysayers in the media and social platforms. So just be a bit mindful of how things stand. The numbers are not dramatic. And if I just give you an example, Chinese inflation number has gone only from negative 0.9 to plus 0.5. So it's a 1.4 percentage point increase this year. It's quite a bit for CPI, but it's actually not but it's coming off from a very low base. So, and China is actually being talked a lot about because of them being a big consumer of base metals and a lot of commodities, and there are huge demand in the COVID situation is actually driving up a lot of prices. So China is in the line of fire for inflation in particular. However, the inflation numbers actually wasn't that alarming. However, this will change, of course, if we stay in this sort of supply chain disruption too long, of course. So hopefully vaccines help, hopefully companies adjust, hopefully both work to take that inflation valve away. And already we know that you've seen a lot of news lately that the Chinese authorities are cramming down on their own industries and companies in China, trying to regulate them out of holding these commodities, also trying to discourage state-owned enterprises from speculating in commodity in commodities, and they see it as a risky endeavor themselves. They also see it socially that it will contribute negatively to society. So the states is actually cramming down aggressively on all speculative activities related to commodity demands and supply, and so efforts are being taken, and hopefully that will help in coming months or quarters. So that's my 2 cents on inflation globally. On the blue line, the funny enough, the blue line went up a lot more, which is growth, and not a lot of people talk about it. The media actually is less focused on it. The funny thing is that growth actually jump up a lot more and outpaces inflation. So in a way, you can say that inflation-adjusted growth, which is the ultimate driver of returns, has actually gone up dramatically. Now, why is that the case? Why is the media so focused on inflation? Do we always just blame the media for just trying to create a sensation with negatives? Maybe in this case, not. Maybe let's dig into this little puzzle a little bit more. Here, I have a graph for you. Left side is for growth. Right side is inflation in the US as an example. And the basic fact is talked about a lot, but allow me to explain it briefly. During COVID-19, we have this huge lockdown a number of times around the world, and that created a huge drop in the real economy. So if you compare anything versus last year, the year-on-year change, any months this year that coincide with the bottoms of the real economy last year would see a huge change. In this case, a huge recovery in the numbers, whether it's inflation or growth, it doesn't matter. If you compare May this year to May last year, and April and March, where the months are the most dramatically impacted by COVID-19 in terms of the real economy, all the numbers will be exaggerated. So this is what people meant by the basic fact. And the first way to look at it is to, if I focus you on the left side, left chart, is to sort of look at the red dots. You can see that if I compare year-on-year blindly versus the bottom last year, yeah, I'll get a huge increase in growth. However, if I look at recent trend, as I sort of highlighted with this black dotted line over here, it's a lot gentler than the red line, than the red dotted line. So the black dotted line is actually trending at a 5.5 percentage point a year rate. So growth is actually closer to 5.5, not 10 or 16% or 14% as you've seen in the graph before. It's actually less exaggerated. It is good nonetheless. 5.5 is very respectable, but the basic fact exaggerated it a lot. So that's one way to look at it. And on the right side, we do the same thing for inflation. Again, same thing. If you compare to March, April, May of last year, the percentage changes are going to be exaggerated. So if you look at that, it's about 4.1 percentage point really for the inflation. The US reported something like around 5, so it's slightly higher than the red dotted line. But what's different for inflation on the right-hand side is that the recent trend, based on just 3-4 months of data, is sort of a lot more exaggerated, like it's accelerating. So that's why the media or a lot of investors talk about it, because the last 3 months we've seen a much faster pace in the way inflation changed. And if that continues, it will raise alarm bells. But however, on the flip side is that you can't really make decision based on just 3 months of inflation numbers, and you say that that's going to be a huge new super cycle. That's very premature to say. And so in a way, we're in this wait and see situation when it comes to the right-hand chart for inflation. And the concern is the base effect actually did not exaggerate inflation too much, but really is the recent 3 months of number being a lot higher than people expected that gave them the concerns. So it is clear there is some legitimate reason to monitor inflation closer from here. Now, if I use another perspective, same data, left side is growth, right side is inflation, but the way of looking at it is different. It's just that you sort of take the recent data point, but you completely ignore the COVID-19 bottom in the real economy. You just sort of try to compare recent data, but you jump ahead and you compare to pre-COVID-19 data points. And that's how I drew on the left chart, for example. The lines are now very different picture. Growth actually was negative and becoming less negative. So this is a completely different picture now. Instead of growing a lot, we are still trying to recover to pre-COVID levels. So it's still good news that we are heading towards a pre-COVID level, but it's no longer like a super duper positive charge to our economy. On the right-hand side, it's a bit similar. You can see that the inflation number I highlighted was, yeah, there is some legitimacy, even with this same technique, that inflation is actually still starting to creep up the last 3 or 4 months. So what do we learn from this base effect perspective 1 and 2 that we just talked about here? The simple story is that we are still quite uncertain about what growth is because of the base effect, but the good news is we're heading towards a recovery. So there is uncertainty there, but there's also a bit of uncertainty about inflation, but the last 3 months are clearly, whether you're using the first method or the second method to look at it, the last 3 months of data is sort of creating some concern that inflation is starting to rise. And official numbers 5.0%. The perspective 2 here is saying it's 3.8. Perspective 1 here is saying it's 4.1. We don't know what exactly is the best number to look at, but a clear picture is inflation is true. It has risen for the last 3 months. So we need to monitor it, and portfolios, fund managers will need to take note of it going forward, will pay close attention to it. And depending on future data points, algorithms, or fund managers, whatever strategy we are on, we will have to make adjustments for a world with higher inflation or not. We will find out. At the moment, waiting pattern. At the moment, we need to wait and see a little bit more of the data to confirm it. And a counterpoint to the inflation story is this number here. We call the velocity of M1 money. M1 money is essentially the most relevant for consumers like us. Things in the savings account, things in your current account that you transact with. When you pay online, you do payments and transaction with your banks or with a mobile app, it gets captured by the velocity of M1 money. So this velocity is, what's the meaning of this velocity? It's the speed with which how money actually circulates in the real economy. And if the faster there's a velocity of M1 money, it means that the easier it is to have inflation. Because if truly there are reasons for inflation to go up, the mechanism for how it will happen, it will be through consumers paying higher prices for everything. Consumers transacting in their daily lives for whatever they need in a faster manner. So that's sort of a very good proxy for how inflation is going to happen, which is why we show it here. And the story is quite dramatic in the sense that if you look at my mouse, in the last recession highlighted by this gray shaded area, the velocity of money was nearly 11 times back in the period right before the 2008 global financial crisis. And it was steadily declining since then, all the way to around 5.6 times. And after COVID, it actually took a beating and it went all the way down to 1.2 times. So what it means is that if the government prints money or the central bank prints money, the system, the banking system is finding itself taking longer time to see the money multiply, to see the money circulate in the real economy. So it is a very interesting perspective, and the source of this data is from the Federal Reserve itself, and it sort of tells us that, look, it sort of confirms the point that supply chain disruption is truly behind the rise in food prices, commodity prices, and other prices, but the core driver of structural inflation, the big monster, is not there really. Because this velocity is a reflection of that monster. Is there something that changed in the society, the way we transact, or culture of consumers being changed that will trigger inflation? So the velocity of M1 money is saying no. Yeah, and this is kind of consistent with the story that the central banks is telling us that no, we're not there in terms of inflation. In fact, we need to focus on recovering. So it is exactly what they've been saying and what they've been doing. So hopefully this clears up some of the confusion about all the mixed opinions that we see in the media about inflation. You can get very scary expert opinions on this. You can also get very optimistic opinions on it. But ultimately, I believe that the data, if you look at the data in the right manner, it will not lie to you. You need to have a framework of thinking about this, and data is one of the best ways to support the argument rather than to argue in an endless loop among ourselves. So here, the mechanism of inflation, the driver, the velocity of money is actually at all-time low. So the probability of having a structural, scary inflation in the economy is going to be very, very remote. What we are experiencing is temporary and is due to supply chain disruptions. Well, we are about to finish the presentation to open to Q&A, but I also just want to, since I mentioned earlier about real growth or otherwise inflation-adjusted growth is truly the ultimate driver of all asset class return. Here, I just give you the example. The story is the same if you go to the global aggregate or you go to China or you use the S&P, it doesn't change the story. You can see that the big major turning point in the economy, the blue line, for example, in the 2008 crisis that my mouse is highlighting now, and the big turning point in the year-on-year change in the S&P, they always coincide very closely with big inflection, big turning points in the blue line. The blue line is the real growth for US. The story doesn't change when it goes to global. Similar in the COVID situation and this dip on the right-hand side, similar in the tech bubble burst in around year 2000. So all these big turning points, they do really drive returns. And at the moment, real growth is actually pretty high. If inflation continues to go up a lot, then real growth will start coming down. Just to clarify, real growth means growth minus inflation, let's say. And if inflation is going up more than growth, then the real growth will come down. So that's how you should think about it. And if real growth comes down, then the return that we see in the stock market would also come down. But the moment real growth goes negative, then you will also see a correction in the market. So right now, anything above 0%, so on the left chart, anything above 0%, whether it's up or down, it doesn't matter. It means that the stock market will still be delivering positive return. But the extent, the magnitude of the return is decided by real growth. So I think that's what this graph is trying to explain to you. So it's one of the important indicators that among the thousands of indicators that we look at, this is one of the top 10 indicators that we should be looking at, along with the Conference Board Leading Economic Index, along the velocity of money, right? Real growth is a very, very, very key number, especially when inflation is rising. We need to watch this indicator. So that's what I meant by let the data decide how the portfolio will allocate itself. So, well, and lastly, I want to just close with a few things that really matters, and they got nothing to do with whether you are intelligent investors or not, whether you are a great trader in the market, in and out, or whether you have a secret sauce. It has nothing to do with that. Oftentimes, from what I observe in a lot of portfolios and a lot of investment plans over the years in my career, a lot of it has a lot to do with your financial plans. And so here is a reminder for myself, but I'm sharing the reminder to you that first, before you invest, always determine the right amount of sufficient rainy day fund that you should have for your, given your personal circumstances, before you invest your first dollar. You need to sort that out. What is the right number for you? Having too much, you miss out on returns. Having too little, you have too thin a margin. Should anything change with your jobs or any personal situations, you don't have a margin of protection. So financial planning is one of the ways to determine what's the right amount of cash buffer for you. Number two, planned. Need a long-term investment plan that tailor to your personal situation, that tailor to your personal life goals. Why we invest, you may think is a stupid question, but it is a very important question. Because if you say you are investing for retirement and 30 years from now, you have a 30-year horizon. But if you say, I want to invest to put a down payment for an apartment in 3 years' time, then you have a 3-year horizon. 3 versus 30 years, a very huge difference in terms of time. And the time to your goals is a very critical component to determine the amount of risk you can take. The more time you have, the more time you have to recover from any random shocks in the market. The less time you have, and supposedly tomorrow is down payment for the apartment, and you take too much risk, and the market drew down 50% tomorrow globally, that we have a meltdown or crisis and something unexpected, then you don't have the time to actually make the down payment to recover there. And so the 3-bedroom becomes a studio, right? So it is very important. The time to your goal is a key determinant. So plan carefully. 3, what I just said in plan actually has everything to do with risk. However, risk management cannot be done only when an event has already happened. It cannot be done when the news is talking about it. Risk management has to be preemptive, not reactive. So I would say from day one, even before you invest, find the right risk level that's compatible with your temperament, your tolerance, your personal situation, that won't make you sweat and sleepless over the weekends. Choose the right risk so you have a better quality of life, and also so you won't overreact to any short-term volatility in the markets. Very, very important things. To be able to unleash the power of compounding, time in the market is very important. But if you take too much risk, your time in the market may be cut short when you emotionally react to any short-term gyrations, and then only to find that the market rebounded, but you're out of the market. And what would you do after that? It's a very difficult situation. I've seen it happens a lot back in the last financial crisis. That happens to a lot of people I know, and happens a lot in COVID-19 as well, in the way the market rebounded. So you need to have a plan. You need to have the right risk level in the plan, and you need to stick to that plan, which is point number 5. Point number 4, I jump ahead. Diversification is the best thing to do. You may research and get passionate about certain asset classes or a particular company stocks or what have you. However, it's always about allocating correctly. You should never have 100% of your net worth all invested in just one asset class or one industry or one company stocks. You should always harness the power of diversification. It's the only free lunch in finance, really. I'm not sure there's many other free lunches. It's one of the few free lunch. Diversification can be created with mindfulness, thoughtfulness, and a great financial plan. So with this, I would leave you with the things that I would constantly remind myself, and I'm sharing this with you. And there's also how we on the platform, in terms of StashAway Academy, for some of you who doesn't know it, we promote a lot of investment education, which talks about the key philosophies about investing that lead to long-term success. These 5 critical points, I can't stress enough that they are perhaps more than half the battle in having a successful long-term investment. In fact, I would say they are as much as 75 to 90% of what decides success. Being a better trader, being a faster reactor to events, or just being smarter than everybody in the room is probably not as big a component as you think. So I'll leave that with you and open things up to Q&A. Can I request that someone from my client engagement team to host the Q&A for me?
Sure, Freddy. So we have a question. What will the portfolio be adjusted based on this market outlook? I believe StashAway's portfolio, will it be adjusted? Is there any actions that StashAway investors should take?
Well, it's a great question. On a real-time basis, we monitor the key ingredients that decide how we allocate portfolios. So naturally, in the future, if the numbers keep changing in a certain way, it will trigger a response. However, at the moment, we are still in a holding pattern. There's a lot of uncertainty. So we will let the data speak for itself in coming months or even quarters. I have no idea when we're going to do it, but the moment it hits the threshold that the model As you know, the model is stress tested a lot. It goes back in history a lot. It goes through a lot of different economic scenarios. It has its own threshold for how much inflation has to go before it responds, how much growth has to go before it responds, how much interest rate has to go, how much valuation has to go before it will allocate. And it's trying to really help you stay in the game for the medium to long term. That's why it does it, to try to risk adjust it correctly. So yes, it will happen when things pass a certain threshold. And at the moment, we're in a holding pattern. So great question. Thank you very much.
All right, thank you for that, Freddy. The next question we have is, given that the indexes are relatively high now, is this sustainable? Would it be better to wait a bit until before we start to invest in the ETFs later this year?
I think there's two ways to view this. Firstly, it's a matter of choosing the right risk, because it's not just about the stock market always going up and always all-time high, and then you get afraid of a correction. The portfolios, right, especially balanced or lower risk portfolio, will start having a lot of different protective assets. Some of them are massively undervalued, right? Some things are actually not cheap, as correctly pointed out by the question. So the key ingredient is that it's not a single asset. It is a portfolio of many things. So my advice would be to think about what risk level is compatible to what you can tolerate as in terms of a surprise event, and that would be the answer. However, for the user who's on the highest risk portfolio, because their natural tendencies and profile is suitable with it, then this question, it means a lot differently. Hence, my second answer is the stock market is always at an all-time high if you look at the chart. You can never look at the chart when it comes to stock prices. If you do that, you would never have invested 100 years ago. You never. There's never a good time. However, it's misleading just to look at stock index, because it's the change that matters for the stock index, not the absolute level of the price. Because if you look at the GDP of the world, right, like 100 years ago, world GDP annual output is nothing compared to today. So the index going up always in absolute value is just reflecting that world output, world growth has continuously grown over the last 100 years, right? It's about the change. The stock market actually is not concerned with absolute numbers. The stock market is more, not the stock market, any market is concerned with the rate of change. And in this case, the rate of change of what? Rate of change of growth, rate of change of inflation. Like I said just now, the ultimate driver of the stock market return is real growth. And as I highlighted in this presentation earlier, the growth side, because of base effect, is exaggerated, went up a lot against inflation, and the stock market has gone up accordingly. But if you sort of think about it, there's some concern, valid concern on the inflation side. So right now, we're coming from a very high number in real growth. Inflation going up a bit may dilute your earning power, may see the stock market still have positive return, but less positive than before. So the more important you need to monitor that, and the more important you need to diversify. It's not just about the stock market. There's convertible bond, there's natural resources, there's gold, there's international bonds, there's real estate, there's rebounding because of COVID, the vaccine drive is unleashing the reopening possibility. There is also risks of different geographies. There's, there's investment grade bonds, there's high yield, there's all sorts of assets that in a mixture tailored to your profile. That's the answer. So I have to go back to stress that if you're concerned about this particular, that the stock market is too high, I think it's a question about risk profile then. The more you should then relook into your financial plans and think about maybe adjusting your risk preferences. So that's the way to handle it, because the graph is always the highest. If you block out the right side of any chart in the market, it's always the highest point ever. But then if you don't know the future, right? Then now you know the future, you look at this, it never came back. So that is a sort of a visual trick that the chart play on you. So a very important thing about that. Think about real growth. Think about growth, think about inflation. Think about changes. It's not about absolute level. I hope I'm answering the question clearly. I really hope so. Let me know if I'm not saying.
No, I think that was really clear and you presented both aspects really well. The next question we have is from Mark. He asks, which news media do you trust to deliver neutral news rather than being sensational news?
This is a great question. I think the media has done a very good job in reporting real time. So to them, it's about time, being timely, being the first one to report on something. The fastest one may compromise quality or accurateness. The ones that takes its time will give you insights. So having more information doesn't mean you get more insights. Sometimes too much news, more information means too much noise, right? So the biggest challenge I have personally when I look at news flow, whichever provider, is that about only 1% of the many, many news I receive, they are truly insightful and relevant and actually going to matter for the economy and the markets going forward. About 1%, not more. And so the quality is really low. You really need to have a high hurdle rate for yourself. When you read, you got to really read between the lines, really put things into perspective. Maybe perhaps is the best thing to do is not to read too many news, but to sort of follow certain inferences that has demonstrated long-term track record, demonstrated thoughtfulness, demonstrated balanced viewpoint. People who write like that with this kind of profile, you have a higher chance of getting insights. But if you look at the sort of the noisy channel, especially in the social trading platforms, it's particularly noisy where it's almost like, oh, my friend does it, they like it, so I like it too. So and so did this and they said this. So it's not really anything that tells you this coming from an expert with a track record. So in a way, you really have to know what are this news channel, how are they formed. So it is too much work. And ultimately, the fastest news is not the news, it's the price of the asset in the market. The price will tell you the formation, the trend, the price of the market versus the economic number. Those are things that tells you whether something is fair, whether it's legit. So I tend to personally, just speaking for myself, I tend to focus on the data and then I will read the news. I don't want to be influenced by the news first before I look at the data, because then I sort of cognitive bias. You're sort of being already influenced because the mind gets lazy because you are now being bombarded by all the news. So your minds will just go dormant and start receiving all these subliminal messages. Sometimes you don't even know why you say something, why you think a certain way, because you've been seeing them a lot. A lot of news keep saying the same thing. And then your mind subliminally react to it and start remembering it. That's actually a very dangerous thing to do when it comes to receiving such stimulus, such stimulant in our modern world. So I prefer to actually shut off, sometimes every once in a while, do some deep reading from people who write something longer term, more insightful, more exciting stuff, and weed out the noise and look at some data on the economy just to get a sense of where things are. So those are the stuff that I do first before I actually confront the news and media. I hope that I hope I'm giving you a complete way of thinking about it, hopefully.
Thank you, Freddy. Next, I'll be combining Ming's question and Nigel's question regarding gold. Ming asks, given the high uncertainty in current market and that inflation rate is poised to rise, what is the role of high allocation of gold in the StashAway portfolios? Nigel asks, any plans to increase or decrease the gold allocation in the portfolios in view of current inflation statistics?
I'll answer the second one first. It's not a choice thing. It's actually systematic. It's based on stress testing. The algorithm has its own logic. The algorithm looks at the economic data and then make the decision. So the investment committee chaired by myself, we are more like the gatekeepers for you, because we look at the signal. We try to make sure that there's no garbage in, garbage out problems. We don't make sure the data in is correct. And also the committee is there to confirm the signals. And the committee is there to sort of like, the only time that the investment committee, including myself, they will override the algorithm is when we have a severe concerns about risk, and that we think that the risk is not being captured by EIAA. So and then we have to present evidence and database evidence before we can override that. So in most cases, we would not sort of have this subjective elements. So that's the first part. But the second part to the first part of this question is that we are truly, here's where my opinion comes in. It doesn't interfere with ERA, but I'm interpreting it for you. The reason it was, the first time we went to a high allocation in gold was in December 2017, when it was trading around 1240. And that reason was a valuation one, because it was the second most severely distorted valuation ever on the model for gold versus economic fundamentals, versus inflation, versus interest rates. And that the algorithm pick it up and say, wow, it's underappreciated. There's a medium to long-term opportunity when this thing mean revert. And so we did it in December 2017. However, last year in May, when we re-optimized portfolio and we ramp up gold a little bit further, was because we were in this very unprecedented situation for human world, human society. We've never seen this before. So much money has been printed in just the last 1 year compared to the last 100 years. Most of the money was printed last year. And so the risk of paper money being diluted by the printing press, by central bank policies, by COVID-induced situations is severe. And if inflation do come, gold will also be one of the very valuable asset classes that we will have to have. So because of the unusual, unprecedented situation the world is facing now, the algorithm further increase those gold allocation for some of the portfolios. And so generally, mostly we maintain it, but a little bit increases because of May last year. And so this is a data-driven decision. There's no intention involved. But if the data comes in and suggests that inflation is actually not that severe, it's actually, hot air, things are changing again, wages are dropping, or the data confirms those things, then I'm pretty sure we will stay as it is, right? And I'm pretty sure we reduce gold allocation because then there's less need. So it's really depending on the future state of the economy and future trend in central bank policies, government stimulus. So there's a lot of those things that comes in. We'll see what happens. I have no idea what the future is going to do. And my advice would be prepare for the worst scenario always on day one when you invest. Your StashAway risk index is a number that we should focus a lot, because it's not just a number that's going to be broken easily. It's a number that's very carefully calculated based on stress testing of the portfolio. Our StashAway risk index was calculated based on all the negatives that we see in the market, all the way going back as far in the data as we can. And especially when the numbers was calculated, we compare the StashAway risk index to the top 10 market meltdown that we've ever seen in the history of financial markets, and see whether the StashAway risk index is enough to capture the majority of those systemic market meltdown, right? So it's sort of a very, very, very big number. And I would really advise all of us to sort of always think about the StashAway risk index. Think about it in your mind, talk about, even sing about it, because make sure you are thinking about it. If you're uncomfortable, that is the number in the app that with a slider that you can change instantly and effortlessly to make you feel more comfortable with your plans. Very, very key. And it's not a number that should be taken lightly. It's carefully calculated. And I'm very happy to say that during COVID, it actually proven that the number works, because the number were very bang on for most of the portfolio. In the most unprecedented market meltdown ever, the fastest drop ever, the second deepest drop in the markets ever, we've seen the StashAway risk index being very, very close to where the COVID extreme has hit. So it's sort of a testimony to how it's calculated. I know it's psychologically not nice to think about the negatives, but at StashAway, we we're trying to talk about the negatives first. We want you to be prepared for it. And StashAway Risk Index is the key way for you to relate everything I just said. It's a key way for you to relate that with your emotions, with your sentiments, with your plans. I hope I'm not overcomplicating the matter, but tell me if I need to elaborate further.
Sure, thank you so much, Freddy. The next question we have is, does increased adoption of the digital renminbi cause any threats to the US dollar as a reserve currency? And how would it in turn affect StashAway portfolios?
That's a fantastic and really intriguing question. Allow me to explain the question in a more meaningful manner as well, because it's a great question. Would a digital way, so the blockchain now, right, cryptocurrencies has harnessed this borderless network to process transactions. Would this, if translated to key currencies like the Chinese yuan, become a game changer for China to capture market share from the US dollar in terms of how globally everybody transact? Can it be the new reserve currencies of the world? I think that's sort of the questions implying. And in a way, yeah, if the blockchain method actually takes off, it's still too early to tell at the moment. It's still in the testing phase. If it takes off and all Chinese innovation companies, all Chinese ecosystems, Alibaba, the Tencent, the WePay, everything that involves payment is being mandated by the Chinese government to be on the digital yuan, then yes, it will really speed up the transformation in terms of the Chinese yuan taking more market share from US dollars. So that is a very, very key scenario. It can happen. And currently it's too early. How is StashAway adjusting to this? Well, really, it doesn't really have an impact because we sort of, when we view returns, we view it in terms of local currency perspective. So even though you see that a lot of the portfolios are denominated in US dollar for our global portfolio, if you're in Malaysia, if you have our Sharia, 50% Sharia compliant, 50% global portfolio, that mix is denominated in pounds, but they are not really exposed to just pounds or dollar. They're exposed to a basket of global currencies. And so really we try to target based on risk rather than market share. If the renminbi, if the Chinese market is still volatile, even though the yuan is taking over, the volatility will mean that we have to allocate less to China because we have to mix and match such that it suits your risk profile, right? However, if China grows and develops and the renminbi is taking market share, the financial market is also becoming stronger, more sort of a developed world sort of a situation. And then, so China then will have less volatility in the financial market with the renminbi. And that means naturally, because the volatility is lower, we can have more of China. So it's really about ultimately risk profile, volatility. And it's not something that we will try to forecast or speculate on. We let the data speak for itself. The options market, the volatility of the financial markets would tell us whether that transformation is legit and complete, right? So it's not just market share, it's both market share and volatility of Chinese markets. Hopefully I'm answering the question.
Thank you, Freddy. The next question we have is from Jason. Jason asked, you mentioned that ERAA has a valuation model for multiple sectors. Which sectors are the most undervalued and overvalued at the moment?
While you stare at the screen, let me have a check. There's a lot of numbers that goes on in the system. But I can answer to you first while we wait, is that the stock markets are not cheap for sure. But they're also not severely distorted because real growth is actually very high. Like I show in the presentation, nominal growth minus inflation jump up a lot. And the world is mending, vaccine is driving up, opening up borders, but potentially, depending on the timing, I don't know, but it is driving towards that direction. So it is difficult is a difficult dilemma because investors who look at the chart or care about prices will never be in the market, and the market keeps going up. But it's also true is the investors do have a valid concern that most of the stock markets that we are looking at in the world, they are not cheap, right? So in fact, if I look at the valuation adjustment that we see, actually emerging market is actually cheap because they are actually more severely impacted in terms of supply chain disruptions, in terms of how they are handling the COVID pandemic. They haven't really recovered as fast as the US stock markets. They haven't recovered as fast as technology stocks, as fast as certain other regions. So emerging markets in general are cheap, but cheap for a good reason. They can stay cheap for longer. They really needed to see more pandemic progress before they would take off, right? So it is a matter of timing. So emerging markets cheap for good reasons. Basically, Singapore actually looks pretty attractive because it is handling the situation quite well. The Straits Times Index is not very tech focused. It's a lot of blue chips, very dividend focused stocks, very systemically big names that represent the Singapore economy. Strong long-term track record of being around. And the vaccine drive, the reopening of borders, the so-called the great rotation of the economy away from the pandemic winners like technology. Technology was the biggest winners and hence the most expensive. So a lot of investors were talking about, professional investors were talking about whether the vaccine drive and reopening would sort of cause that performance to rotate, where the pandemic winners will now do less well than say sectors that's more traditional. So the Singapore Straits Times Index is one of those very, very good places to be long term. Short term, who knows? REITs in Singapore is also one way. But again, this question. But again, at the risk of, there's a risk to me answering you specifically which assets, in the sense that I don't want to promote concentrated investing. So always do be mindful of whatever I just said. If you want to do something about it, make sure it's an allocation, make sure it's rightly sized based on the volatility, right? I would always strongly recommend that you have a diversified portfolio from day one, because the StashAway portfolio actually harnesses all this signal. So whatever I just said, our Singapore income portfolio is multi-asset. It captures the REIT situation. It captures the Straits Times situation. It has a lot of high-quality investment-grade companies in there for the corporate bond. It also has the very safe Singapore government bonds. So it's sort of like a mixture. The Singapore income portfolio is very interesting for the long-term investors to have on, right? There's one example, but you also can say that, wow, a global portfolio also harnesses that too. That's just that the opportunity set is coming from around the world, not just in Singapore. So again, it's very easy to fall into the trap of looking at this and looking at that and forgetting the forest. So I just want to remind ourselves that whatever I just said, the portfolio that we create for you, they're supposed to capture these things. But just to answer the question, yes, REITs are looking interesting. They're rebounding. Medical, healthcare, they're expensive, because the market is always quick to price in any information. So by the time now everybody can agree in this room, right? If you have 100 people in this room, every one of us will have agreed that healthcare stocks are great. But that means that who is left to buy? Everybody has bought. Who is buying it tomorrow, right? So again, this is another trick that the market and the news will play on us. We're going to ask ourselves, this news or this view or this opinion came, is it very common in the marketplace? If it is, chances are it's already priced in. So healthcare, everybody likes it, but it's not cheap, and maybe it's going to surprise on the downside. Who knows, right? So I would really, really caution. But what ERA, the valuation, is trying to do is to capture this thing in a data-driven way, and is to try to reflect the situation of FOMO and also the caveman response, the fight or flight response. So when there's a lot of fear of missing out in the market, everything is very expensive, ERA captures that in the sense that the valuation is too high. It makes a negative adjustment. So we sort of reduce or stay away from the very over-concentrated places where everybody in the room has bought, no one's left. So that situation is a great example. On the flip side, there are also places where it's less appreciated by investors, but the fundamental data is pointing to very strong rate of change, but the market is not appreciating it just yet. And those are places where it's present you with these medium to long-term opportunities. And that's where ERA is trying to capture on the flip side of the valuation. So just to complete the story, I give you a a long-winded narrative on this question, but because I really want to make sure we put it into perspective.
Thank you, Freddy. Maybe I'll take a couple more. So Ed is asking, what is your view on China tech moving forward? While KV asked, why is StashAway not allocating more in the China market?
Well, I think on the second part is quite mixed. There's a lot of people who thinks we have too many, and some people think we have too little. I think it really depends on which risk point you're on. What is the right risk profile for you? If you are naturally, your tendency is able to handle larger volatility to your net worth, you will find that the 20% allocation we have to China innovations as a whole asset class, you will find that quite nice and compatible. But for somebody who had a less tolerance for volatility, you will definitely think 20% is too high, and you wouldn't have that. So ultimately, the question is your risk profile and choosing the right risk profile. So too high or too low, it really depends on that. So I hope I answered that one first. Sing, can you remind me how the first part of it is? Say again.
Yeah, the first question is, what is your view on China tech companies moving forward?
Well, I think, like I presented earlier, the very early part, but I think I should emphasize again, is that there's short-term headwinds that needs to be worked through. The Chinese government still is heavily relying on technological advancement in their 5-year plan, 10-year plans, 15-year plans, in how they want to restructure their entire society and economy. So that's not going to change. And they're going to invest heavily. And they're going to sponsor a lot of that too. So that long-term story remains intact. You cannot miss out on that. In fact, the short-term headwinds are only a blip to that big ambition, because slapping Alibaba with a $2.8 billion fine is like, if I'm not wrong, it's like 5% of their yearly revenues. So it's like a slap on the wrist. It's more for signaling effect than really trying to kill your own tech firms. It's really not about killing your own tech firms, not about that. It's really about leveraging the playing field in tech for other companies to grow, and not just the two kingmakers in the system crocking up the whole machinery. So it's really about that. And it's really about consumer protection, how to prevent abuses of personal data, right? So these are very welcome, healthy, medium and long-term developments. It will be worked through. The tech players are getting the message from the authorities, and they know that in China, you have to play along with these big plans. So it is going to happen. It is going to work. And the digital yuan is also going to be forced onto the hands and platforms of most China tech companies as well. So it's a very centrally organized, coordinated economy that's very, very large in China, and that's not going to change. So technology is at the forefront and center of it, and we're seeing a slap in the wrist today. And I actually personally, my personal opinion, not data, my personal opinion is this opens up opportunities for the long-term investors, for the investors who's investing their savings every month, right? Because you're investing your savings every month, you're building up your investments. You need more time. So this sort of blips in the near term are extremely attractive for the real money, the long-term investors with a plan to go with, because it actually means that your latest month's contribution is going to buy you more units of the underlying shares in the entire China innovation sector. That's great, fantastic, we have value for your money. But near term, of course, maybe you won't see returns immediately, right? So it is really about the timing. And so I personally am excited about China tech, super excited. I'm also super excited about the changes this is transforming societies with. And I'm excited about the current opportunities with the headwinds now that it opens up for investors like us on our platform. So I think I'm a very optimistic person in the long term for China tech. Let me put it in the no uncertain terms.
Thank you for that, Freddy. We have a question from Julian, who is watching from our YouTube live. He's asking, if there is greater signal from the US Fed on tapering, how would that potentially affect the StashAway asset allocations going forward?
Well, the Fed, like us, react to the same thing. So when we first design our investment framework, we are thinking about one of the key things is how does the market react to it, but that's also how the central bank react. As you know, the central bank looks at the big things like growth and inflation. It's not about individually either one, it's about the nets, growth versus inflation. That's why the Fed hasn't raised interest rate. That's why the Fed is always maintaining the support in the market, right? Since the COVID crisis. In 2008 crisis, the same. They take their time to slowly taper because they know that the velocity of M1 money that I mentioned before is very low. Even though the economy is on the mend, we are still very fragile with livelihood of real people in the real economy. And the life support should not be too abruptly be disrupted. We need to be very careful when we withdraw it. And they will withdraw it very slowly. They will withdraw it very gently to allow the economy to sustain. So this is as long as the mechanism for inflation is not there. And the mechanism is velocity of money and is not there, right? So that's what the message of the Fed is. And it's a data-driven one. At the Fed, there's hundreds and thousands of economists that they employ and also data scientists. They look at a large number of data, but the broad category is growth versus inflation. And that's what EIA is designed to understand as well. It looks at the same thing and makes the same decision. You don't want the Fed to announce a rate hike and contracting and then you react. It will be too late. You want to look at what data the Fed is looking at, understand what they are going through, understand what the market is going through, and you make your adjustment regardless of whether the Fed is hiking or cutting interest rates. That does not factor into our equation. The way it factors sometimes is where you have this forward-looking market expectation for whether the Fed is going to change the cycle, hiking cycle or cutting. There is a little bit of the sort of model dependency that looks at that. It's a very small number. Majority of it comes from independent factors like growth and inflation. So again, it's really, really about this.
Thank you, Freddy. One question that we have is, what is the asset allocation of your own portfolio, Freddy?
Well, whatever I save, I invest is in the StashAway portfolio primarily. Sometimes there's a small allocation in something that I like. If there's a startup, if a friend is opening a startup, has an innovation venture going on, I'll put a small amount in there, right? So there's a lot of hobbies, personal hobby or investing pet project that is a very small amount. The majority of it has to be diversified, has to be very safe, and it's exactly the same way as how our platform manages.
Thanks, Freddy. Maybe one last question. Ning is asking, do you see any chances of uncontrolled inflation happening, which would cause the Fed increase rate significantly in a short time? Maybe I should repeat that.
Yeah, I understand. It's okay. Fine, thank you. Yeah, no, the Fed has the culture of the Fed, in the history of the Fed, other than the late 90s under Governor Paul Walker, where they killed the economy in 1 year. Because in the 1970s, as you know, we have an oil shock. However, it's a supply chain disruption, isn't it? It's due to the Yom Kippur War, it's due to sanctions and countries not exporting because of political warfare. And it generated a 400% increase in oil. Hiking interest, it also goes to prove my point that hiking interest rate don't help, because the root cause of inflation due to oil is an oil-related matter. It cannot be changed or improved by hiking interest rate. So the Fed learns from those lessons a lot. And if you look at all last cycle they have, the culture of the Fed is not towards a disruptive behavior. They tend to be very thoughtful. They tend to smooth out the reaction function. The last thing they want is to be the reason why the market is volatile, right? So this is something to keep in mind. So at the moment, like I said, velocity money is low. There's no main mechanism for hyperinflation to come in, so they can take their time. However, at the same time, they don't want to promote incessant speculation in the market. They don't want to be seen as a blanket guarantee for the market. So the communications challenge really, rather than an action. So the communication challenge is really a big one for the Fed. And it's really about how they're going to signal to people, how to steer the right behavior, how to warn people away from, say, meme stocks or all the funny stuff that's going on because of there's too much money going on. So this is a challenge, but it doesn't mean the Fed will hike abruptly. This is not the history of the Fed. It's not a culture of the Fed. It's a very data-driven institution. So that would be my personal observation, really, on this. If I'm not addressing the question enough, let me know.
Yeah, thank you for that. I see a few more questions coming in, so let me quickly read them out. Michael is asking, do you think we are more likely to eventually enter a low growth, high inflation environment or a high growth and high inflation environment?
The inflation component, like I mentioned before, is closely monitored now. So that means the probability of inflation being the one that drives things is actually higher than before. At the moment, it's a holding pattern. On the growth side, the story is quite clear. We're on the mend. If you think about it, right, it's like a poker hand. If you think about it like a poker game, in terms of risk and reward, given where we are now, given we are not traveling a lot, given the world is now still in the COVID threshold, but the market is still here. So there's nothing that the market hasn't priced in. There's no downside further to say that things are going to get worse because we are. And so then the asymmetry is that there's only more upside long term when I think about things opening up, when I think about the vaccine success, when I think about other things that goes on, right? So the negatives is in the price, whereas the positive is slowly coming into the price. So we could actually very well have another 10 years, just like the last financial crisis after 2008, from 2009 onward, we have a 10-year run. This could be another new 10-year run. Who knows? I'm not going to speculate on that, but the reasoning is, the way to think about it is risk reward. Given the bad news are all here we are. How bad can it be if I'm wrong about this? Now, about the good part, a lot of it hasn't come in. If they come, it's only going to help, right? So the asymmetry is in favor of being a long-term investor more than ever before. In fact, it's super exciting in the next 10 years, I think, for financial markets, rather than being a very gloomy one. I think it's full of promises. As long as you sort of have the right risk profile, have the right diversified portfolio that tailors to your situation, as long as you can stay in the market, don't get KO by the market, do everything you can to avoid getting KO by the market. That's the main thing. I think that's the one sentence, the mother of all sentences: don't get KO by the market. This is the best ever time to invest for the next decade. Stay invested, do anything, change your plan, do any adjustment to make sure you are not KO by the market.
Thanks, Freddy. I like that. Don't get KO'd by the market. AJ is asking, do you think the implementation of a global minimum tax system will affect earnings and the economy in general?
Actually, a little bit, not so much. This is the summary, but allow me to elaborate a bit. The global minimum taxation is actually not a blatant raise in taxes. It's actually to adjust for the differences in taxes. Because right now you have safe haven like Caymans and British Virgin Island that have zero taxes, when yet companies that actually derive their earnings in the US is paying much higher taxes, right? Like something like 28 to 30%. And so there's a little gap here. And however, by imposing a global minimum tax across the board, so right now the G7 countries agreed. Next, we'll have to go to the G20 to sign another accord. Then after that, you need 140 countries to agree. So it's going to take a while. I don't know when we're going to pull that off. But assuming they pull this off, it means that if you're in Cayman and you have zero taxes in Cayman, you are still liable to pay the difference. The 15% global minimum taxation proposed, the 15 will go to your home country. that you can't run away from the US taxes. So it's a way to adjust for the differential rather than to really, it's not a real blatant increase in taxes. And in a way, you may say companies like Amazon and a lot of global tech companies, because of the borderless nature of data and digital services, this is actually directed at trying to capture some of their revenues that's not in the US. And a lot in already without this, however, you have a different situation where countries like France and Germany would independently on their own, don't care what's happening around the world, they just slap unilateral taxes on companies. That's what France and Germany has done. Those ad hoc, they call it digital tax. And that actually is worse because if countries don't look at each other and start doing their own thing, all these taxes will sum up to a big number, right? If they spiral out of control. So it's actually better to have a global standard, a global minimum tax that adjusts for the differences in taxes across countries. So really it's about that. It's not really a blatant big negative impact. It is not positive, but in a way, it is fair, it is moderate, it's not really going to be a decisive trend setter for financial markets. It's not.
Thanks, Freddy. Ming is asking an interesting question. Catherine Wood stated in her recent market commentary video that instead of inflation, there might be a deflation in the future due to innovative technologies, which will ultimately improve the productivity significantly and drive growth. May I know what is your view on that?
Actually, if you give yourself enough horizon over the next decade or two or even longer, and Cathy Wood is very good at spotting futuristic trends, and that's how they invest. They invest without caring what the market is saying. They are pure technologists who looks at the merit of the companies they want to invest in. So given their profile and their style, they're talking about very long-term trends. And in the long term, I actually completely agree in the sense that there's a structural reason for why prices are cheaper always. You think about our behavior, we are now shopping online more, even for supermarket stuff, groceries. And we get lazy at home, but prices are also driven down because of the e-commerce platforms, because of the efficiency of the technology behind logistical maneuver that these companies are great at. And that brought savings to the average consumers en masse. That is actually a very structural factor. And temporarily right now, because of COVID, we sort of got surprised and got hit by this COVID situation. So temporarily we have this rise in materials and food prices and metals prices. So in a way, Cathy Wood's reasoning is very sound. If you look beyond the next few years, it actually is a very structural, very sticky, very persistent reason, a very persistent trend. We are likely to see more competition. Everything is going to move faster towards competition in the digital world. And COVID has exaggerated that sense of urgency towards more e-commerce, more online activities, more innovation. So it really is structurally, maybe I think it's deflationary in the very, very long term. So for sure.
Anonymous here would like a clarification. So he says, correct me if I'm wrong. What Freddy is suggesting is that M1 money supply has a correlation with inflation. However, historical data based on the US doesn't seem so. Anything that I'm missing out on?
Historically, the data is very difficult to just do a correlation because it's a bit like looking at the prices of the S&P and try to explain it. No economic factor explains it. But once you look at the rate of change, then it explains it. However, this indicator is for big turning points only. So if you do the rate of change, I don't know how you want to do the window, but if you look at the rate of change, certain big turning points in the economy, like in inflation, they do have a certain explanation power coming from this velocity of money, right? So it's the mechanics. However, the data is also sort of diluted by other factors at play. Because for the last many years, there's so many other things going on in policies and governments that, and then technology was being mentioned as another, the productivity gains that we have from technology is also lowering prices. So it's sort of like, it's another factor that going against it. So it is very difficult to disentangle a data by just looking at whether they correlate or not, right? So a lot of data science will have to go into that to really quantify how many percent of it is due to that. So I agree with Anonymous' comment that it's hard to see that correlation. But for me, is in this case, you need to use a logical thinking. And the logical thinking behind it is our banking system it's a fractional one. So for example, you have $100 in the banking system. The bank as a whole, they don't hold $100 in the system and do nothing with it. They hold $3 for reserve. They lend out the other 97 on average. Now, the other 97, let's say, Si Ying borrowed the 97 entirely, and she put it in the bank account. The banking system now go from 100 to 197. There's a $97 of new money being circulated now in the banking system. And now 3% of the 97 is going to be in reserve. 97% of the 97 is going to be lent out again. So there's this multiplier effect. That's the reasoning behind the velocity of money. Whenever the central bank prints money or inject money or withdraw money, it has a multiplier effect on the banking system. So when the Federal Reserve stop buying assets in the market or actually start withdrawing liquidity in the market, then also the velocity of money will contract the amount of money in the banking system multiple times. So that's why it's a very non-linear mechanism here. The data will not show you because any regression is linear, right? So just to make it clear, when the velocity of money is high, money flows very fast. When the central bank high interest rate and withdraw money from the system just a little bit, because the velocity of money is high, the contraction happens a lot faster as well. It goes both ways. Money don't just grow, right? It can also contract. So the contraction will be more multiple times, will be also faster. So that's why the Fed has to be very careful. And so if in the future, when we reopen and the situation is over and the world is doing better again and the velocity of money re-increase again, the Fed actually still has to conduct their interest rate hikes and tightening very, very carefully because the velocity of money would also have increased in that recovery. Right now it's low because we are all in this lockdown or semi-lockdown situation or non-traveling situation, right? So in a way, that's what the velocity of money reflects. And hence, that's what I meant by the mechanism. The Fed don't actually have to high interest rate or tighten now because the velocity of money is low. It's actually not going to help a lot, right? So I think we need to think non-linearly. So when the velocity of money is low, impact of central bank policy is low, right?
Thanks, Freddy. We have a question from Anonymous. He is asking, would the financial and energy ETFs be considered given the rotation out of the winners of the pandemic?
Energy is not cheap. They've gone up, done very well this year. So, but for the same reason as commodities like base metals, right, like copper and nickel and some food prices, in this complex, all of them has gone up a lot because of the supply chain disruptions in the pandemic. So a lot of it is priced in the market. So it's hard to say that it's interesting at all. It's interesting. It's not interesting paying the high, but then the underlying driver, the reason for why it should be high is already absorbed by the market. So for me, I actually don't have anything to say about it. I'm neutral because I feel like the market is rightfully where they should be. And if I deep dive further into the earnings of the underlying companies, the miners, the energy companies as well, actually the earnings per share of those companies are starting to actually recover a lot. And if you look at the forward indicators like the analyst expectation going a year out, a lot of you look at the data, a lot of it is actually gone up a lot. But at the same time, the funny thing is that the price earnings ratio is still not crazy high. It's still quite fair. So it's sort of like, even at such price point, it done well last year. The market is telling you, the PE ratio is telling you that the market is actually not going crazy about commodities or energy stocks. Actually, it's just fairly priced. In fact, if their earnings continue to be better, there's continue to be some long-term potential. But again, for me personally, it's neutral because a lot of it, whatever I just said to you, everybody knows. All the professional investors, all the specialists in industry, in this particular industry, they know. So the market has rightfully priced in the information. There's nothing valuable I can say today that they don't already know. So to me, that's why it's a neutral.
And Jason is asking, hi Freddy, private money is getting increasingly common. Any thoughts on digital currency or asset that could succeed in a Bretton Woods scenario?
It's a very interesting question. If we look at the cryptocurrency space, a lot of the tokens are utility tokens. So they're not backed by a specific currency or asset, right? For those of you who's interested, read up on McAfee's law, METCALFE, McAfee's law. It's one of the law that governs how to value the network effect. And cryptocurrencies like similar to stocks like Facebook, Tencent, Amazon, they have a marketplace, right? Amazon and all those. So there's a network and where people transact very persistently, and there's a economic value to it. So the network effect, the McAfee law, has a way of valuing utility tokens or utility currencies. So it's not zero, it's not trash, but there is a way to value it. But it's not backed by anything. And because it's not backed by anything, it's based on utility instead. The volatility of these currencies is going to be high. Even Amazon stocks is a great name, great potential, has done very well. It's a bellwether for tech, but its stocks is not really for the faint-hearted, right? It's actually, there's a lot of volatility in there. So it's the same. Even though it's a great name, it will have volatility. So utility-based token is a bit similar in the sense that it will be volatile with or without human animal spirit, with or without greed or fear. It is volatile by design of McAfee's law, which is a way of valuing networks. And in McAfee's law, it's stated that the value of the network or the token is proportional to the square of the monthly active users on the network. And so in the case of Facebook, it's 10 to the power minus 8 times millions of users. So there's some computer journal that there's such paper being published in computer science journals. It's not uncommon. And however, it doesn't mean these tokens are worthless, but it's really dependent on utility. Now, it's volatile for sure. And also there's a second thing about, given there's so many private tokens out there competing for the same attention from investors, ultimately, whichever tokens loses critical mass, loses active users enough, it will also be very volatile and negative. So it's proportionally squared down if that happens. However, the winning currencies will gain a lot more active users, and hence will have a square proportional up effect, right? So by design, volatile and is a survivor of the fittest one day. It's my personal opinion that the 7,000 tokens that I think I'm not counting all of them, but let's say the 6,000, 7,000 tokens that we are seeing around the world now, a majority of it is going to fail, and there will be emerge some winner-take-all situation in this particularly interesting space. And it's very difficult for me to predict.
Thank you, Freddy. Ming is asking also, may I know what is your view on clean energy ETFs, since many countries have started launching their policies to support clean energy development and adoption?
Yeah, in particular, the US, with the Biden administration, in the next 10 years, they budgeted, I think, around $1.5 trillion of cash credit, cash sponsoring or tax credit to companies that promote clean energy. And that includes electric vehicles and the battery storage technologies. R&D is also included, anything that's clean. So there will be state sponsorship, but it's not really that clear cut in the sense that the first thing we have to handle as investors is that how much of it is already known in the market, and is it rightfully priced? And I actually hate to say this again, a lot of this Biden reform bill has been priced in. So investors won't do well with a buy anything approach in clean energy. You actually have to have expertise, or you have to know people with expertise who can give you very good advice in terms of which companies would be the companies of the future in this trend. Not every company is going to do well, even though you have the clean energy sponsorships. So it is very key. Then the skills involved in trying to pick winners and losers is going to be immense. Not all of us have that skill set. So it is going to be a challenging one, even though the trend, the team is in play. And so I would actually prefer instead to think about it as, okay, given I have no edge in this particular area, I sort of buy a diversified ETFs. Okay, that's fine, but it's still one asset class and it wouldn't be the best way. I'm better off, yes, buying it, but it's part of my allocation in a broader diversified portfolio, right? So you still need to go back to this thing about the majority, the 80, 90% of it should be sort of a very diversified approach. And then the remaining can be a bit niched and specific, which is fine, right? So that goes back to that. If I just want to make it very clear.
Thanks, Freddy. We have questions about cryptocurrency. So PY would like to hear your thoughts on crypto ETFs. And there is also a question on, is it possible to put an intrinsic value on cryptocurrency, and on what basis might it be?
I'll answer the second one first. The intrinsic value is related to what I just said about how to value a network effect. Go to the internet, you can Google McAfee's law, METCALFE law, LAW. So it's like the Morse law equivalent for networks. So it's a bit, there are a lot of applications of that to value networks. So there is intrinsic value, but it's based on utility, like I mentioned before, based on the satisfaction of people on the network, happy to be there, happy to buy and sell from each other. Each transaction, each buy and selling has a transaction fee being earned by the platform, right? By the marketplace. And in this case, if Amazon has a marketplace, Amazon earns a fee on every transaction. However thin they may be, but it's a loss of large number. With a crypto or blockchain-based network, is similar. Every transaction is processed by the miners, verified by the miners. The miner earns a small fee on every transaction, right? The key is the loss of large number. So what I mentioned there is the same. There's some intrinsic value. It's not zero. Unlike a lot of traditional fund managers, trashing this very innovative new space as zero, being worth like nothing, it's also extreme. I don't agree with that. But also I have to agree that valuations are very, very frothy as well versus fair value. And by fair value, I mean McAfee law. There are ways of modeling and valuing this intrinsic value. So interested reader, definitely go there. Please do me a favor, remind me the first part of the question again. Is it the ETF?
Yes. So what are your views on cryptocurrency ETFs like ETH, ETF?
In general, I'm not in favor of using ETF to get exposure to cryptocurrencies, because I think direct ownership is better. Like if you don't want to store it in the cold wallet yourself and suffer hardware risk, you can use a crypto exchange that does it. And of course, there's always a risk of cybersecurity, but they're getting better and better at that. It's still better than you doing it yourself. However, using ETF, the danger is that a lot of people don't really look at the tracking error, the tracking difference in the ETF versus the underlying value. And there's a lot of cases where, because there's too much demand or sentiment or greed or fear, the ETF a lot often in the good times, they trade at a premium to the underlying tokens. And then there's no reason for the premium to be 40% or even more exaggerated cases have been seen, because after all, the underlying is the token. So the less informed investors using ETFs could end up paying crazy prices to a volatile markets for token and never will have any upside, right? So pricing is important. I think ETFs today, they have a long way to go before they improve the way they are able to keep the tracking error sensible. Currently it's a bit, I think ETFs actually is risky for cryptocurrencies because of the tracking error and because of the erratic behavior in its tracking error.
Thanks, Freddy. We have also a question from Jean. Do you see the G7 teaming up to contain China and Russia affecting China's market valuation?
The teaming up for sure is really the West versus China. And given Russia's relationship with the West, sort of Russia has no choice but sort of be closer to China. Same thing with North Korea. So there's the trio around there. Sure, if you want to put it that way, it's actually quite true. How does it affect market? Yes, it does. It wouldn't just linearly affect market. It will restructure the ecosystem. So when I mentioned about semiconductors and hardware chips making, 5G networks, why the whole ecosystem globally used to be dominated by US, and now it's going to be split into two because China is huge. China is going to continue to restructure its economy based on this components. It's going to invest heavily in it. So the war has to do with both superpowers. So Europe has to decide if there's a sanction, you want to sell to US or you want to sell to China. But under Biden, that goes away. Under Donald Trump, is a problem. So with Biden, would be more sensible, would be more multilateral. So in a sense that Europe don't have to choose. They probably have to deal with both US and China, right? So have to tread a fine line between making any party unhappy. And so in the case of Europe, for example, and so same thing, I think the whole world will have to deal with it. If you are the semiconductor business, you have to deal with both. And you may focus on one, but you don't want to piss off the other one. So it will be a situation like that, a bipolar ecosystem. But it doesn't mean the whole system will just stop here. The whole ecosystem, because of this, actually can grow even faster. Because now there's two superpowers competing, investing heavily, consuming the parts. And so there will be competition for the two parts to grow, right? And as a whole, it's more exciting for a semiconductor, chips, or a technology investors to be even more excited about, because you are forced to diversify even more. You can't just always take a US approach. You also have to have enough China. So I think that's actually a very good thing for investors in the long term.
Thanks, Freddy. For a newbie investor, how do you think of investing in property via REITs versus directly purchasing, owning, or managing properties?
REITs or risk ETF are the liquid options to doing so, or in a more diversified manner, a multi-asset income portfolio with 35% allocation to REITs would also sort of do the trick. But those are liquid options. Liquid alternative for you to do so. The difference between physical versus the fact that the liquidity profile, right? I mean, you take longer to buy and sell. And also you have agent fees and maybe state taxes, clear stamp duties and the likes, GST. So in a way, it's less efficient from the angle to be sort of owning a home physically just for investment reason. You want to own a home for, let's say, if you're a young person, you want to own a home because you want the mortgage insurance. If something happens to you, the mortgage insurance covers the home, is yours. So that is the great attraction of starting young and contributing to a mortgage and own that mortgage insurance, right? But then to speculate or to invest or trade houses because of pricing, you want the price to go up or down, is actually less efficient, and you're better off you're more diversified, you're more risk balanced to use a REITs or to use a risk ETF or to use a diversified multi-asset income fund, right? So I think the difference is quite clear: liquidity, taxes, and also the reason why you use them, right? And I personally like REITs and the risk ETFs and the income portfolio because with a click of a button, I can allocate very quickly. I can also withdraw very quickly. So it's actually a very good feature to have. And it's very diversified, right? If the risk ETF in Singapore can easily own the top 23 REITs and with a different profile. Some are shopping malls, they will have logistics where there's warehouse and data centers and hospitals, hotels. And so there's a lot of different kinds of REITs with different revenue streams, revenue income, that a ETF can actually achieve a very strong diversification for that. And if you want to take it further, because REITs is still one asset class, it's concentrated, you're better off to have a variety. Then, of course, right, income portfolio is the other way. So overall, those are all liquid stuff, and it will suit most investors. But I wouldn't confuse and compare it. As a person, if I want to own a home and have the mortgage insurance, I will still own a home physically. But I wouldn't confuse it with investing my savings outside my home, outside paying rental or outside buying a home. It's a separate discussion in terms of those are my excess savings outside everything else. And I want to invest them systematically. I think REITs, REIT ETF, or portfolios with REITs are great places to be. So it's really, I think what I just said is really it's probably the most balanced way to think about
it. Thanks, Freddy. We have one more question from a new joiner. He's asking, does StashAway basically use a dollar cost averaging strategy to review and adjust its portfolio if need be via software and human discretion based on certain parameters? So maybe Freddy would like to address that.
First of all, welcome to the platform. And the control of whether you dollar cost average or not is in your hands. Because if you contribute $500 this month and you choose next month to contribute another $500, if you choose to do so every month and it's in your hands to choose that, then you will get that dollar cost averaging. It doesn't really has anything to do with how StashAway transact. But then on how we transact is algorithmic driven. And also to prevent us from influencing markets, driving changes because of liquidity reason or because of our size. And there's a lot of users on our platform. So you do need to, the algorithm split the order through the day in the US. If it's in the US, it will split through the whole US session. If it's in London, for those of you with a portfolio around there, it will split through the whole trading session in snippets of orders that the other market participant don't really see or observe. So it's called a guerrilla warfare. They play like a sniper. You want to hide your order flow so you're not targeted by other people, right? And so that is actually algorithmically driven, the way we execute your order. But the way and the whether you want to do dollar cost averaging is in your hands. And yes, we do really recommend savers to use dollar cost averaging to as a way to build up your wealth. If you inherit a lump sum, then you have a different problem. And we do still recommend splitting up the lump sum over several months to try to reduce the noises to your net worth. So the dollar cost averaging, in this case, still is in your hands, yours to decide. We are here to advise.
Thank you, Freddy. Is StashAway planning to launch CTFIS approved product soon?
We never say no to business. We wish to do every business under the sun. So of course we want to. And the matter is that I have no idea what the timeline is going to be. We are working on in parallel as a firm. We always want to innovate. We also want to bring more access to more assets, different types of assets, different geography, different markets. Also going to different platform to reach out to users. We're always looking into that. That will not stop. As a firm, we have to continuously explore this avenue. So sure, we never say no to business. Of course, I want to do it. And it's work in progress.
So one of the questions that just came in is, how is the projection for StashAway's investment done? The number seems to be on the conservative side.
It can't be humanly determined. It's data driven. And the reason you felt that the projection is a bit lower is because the data is very long dated. It went through a lot of sample with negative stuff, like went through the financial crises, and in the past crises, it takes in a lot of that. And it's actually quite true because the last 10 years, primarily last 15, 20 years, the market is more sort of biased one way, but the future is going to be more, who knows, can be more uncertain, right? Then it will never repeat itself. The last 10, 15 years may never repeat itself. So we sort of go back much further, looking at a variety of economic environment in much more detail. And when you go through those cycles, ups and downs in your sample and your data, it's inevitable that the projections will be lower. It's not because we want to be conservative and hence we lower the number versus what we can do, but it's more like we actually gone through deeper studies, longer studies, to come up with it. And naturally, those samples will be more conservative than the last 10, 15 years that we have seen.
Does StashAway have any future plans to partner with Malaysia Kwsp?
I do not know how to answer because I'm not aware of anything, but I do know that we have teams that constantly looks at opportunities to collaborate, either do yourself, so there's those new projects, or we want to collaborate. So definitely there are talks that always goes on as part of our business. Discussions always flying around with people, with other firms. But at the moment, I don't specifically have any idea about this conversation.
Thanks, Freddy. If inflation fears do play out in 2020, continue to play out in 2022, will gold or silver be a good bet to hold on to?
Well, the natural response is to say they should go up, right? And that rightfully long-term, yes. But this precious metals, day-to-day movement are very unpredictable and random and noisy. They are volatile and can get very difficult for the traders to actually decipher it. So the StashAway viewpoint is that we want to harness its property, its long-term key property, its property as a portfolio insurance against adverse event and against inflation. So we want to harness that extreme capability, and we build it into the portfolio so that it would protect you when an extreme event happens. So we sort of think about it as an insurance rather than to think about it as a bet or a trade or even as an investment to expect returns out of it. We were really trying to use it to complement the remaining of the portfolio to make them safer and stronger and more resilient. So our viewpoint is a bit different. So I can't really tell you whether it's a good bet or not, because prices are not cheap either, right? It bounces around a lot. It is a volatile market. That is my honest answer.
Thanks, Freddy. I think that's the end of the questions. We don't have any new ones that are coming in.
Well, I show my face here. Thank you to all of you for putting up with my ranting. We will do this again, and we really hope to see you again periodically when we update all the signals and insights. It's always great to chat with you. If there's any questions you felt is not well answered or remains unanswered, please do post them to our customer engagement team. We will be addressing them with you specifically later. So with that, I bid you good evening. Thank you for coming.